In this episode, we're going to talk about the wealth reservoir, and I think in particular, we'll probably riff back and forth between the wealth reservoir on a personal side, but also the wealth reservoir mostly, I think, in our corporation side. And we're going to be selfish here. These are tools that we're using and trying to optimize inside of our own businesses, our real estate corporations, our operating business, our holding company business. Like, we are optimizing the wealth reservoir tool. That tool you've heard us talk about here is the whole life insurance policy tool as a pass-through structure. And why we want to talk about that tool here specifically today on the corporate side is when we meet with our business owners, our clients, some of the questions about establishing your reservoir, your emergency fund. This is the fund that you have access to. No questions, no back checks, none of this. It's like you have this pot ready to go for investment opportunities, for, again, like I said, emergencies. And sometimes when you go to set this up, and why that tool we've talked about many times here is so important, is because you get two uses to the same dollar. You don't have idle cash sitting around doing nothing. If you got a bunch of cash in your corporate accounts for emergencies, we put our money into the wealth reservoir tool so that we have liquidity, but also the money's growing. And so some of the questions that we get asked is specifically is like, well, how much should I choose to be, the top end of this kind of range for my contributions each year into the tool, which is your premiums for the insurance policy. Sometimes we get hung up on that. It's like, well, what happens if next year is a down year? What happens if it's an up year? I don't want to have more cash sitting on the side when I could have put the two uses to the same dollar now. And so it's sometimes we get that question. It's like, well, how much is the right amount? And there is a range. You can decide on the range, but I want to talk about that because I think we've got some solutions. We've got some strategies we've been putting together on our side, because we also battle that. And also, when you have growing businesses year to year, you make more money. And now it's like, well, what do I do with the extra cash, knowing that I've maxed out my existing wealth reservoir pool? So let's get into it. Kyle, what are you hearing from business owners?
Yeah, and actually, I hear a lot of the same things, whether it's business owners or individuals who are investor minded, right? And looking to make investments and so forth. And really, that challenge is trying to figure out what's the right amount. And we'll never get this right. There is no way to get it, quote unquote, perfect. But usually, as a starting point, I like to get people to think about what is that amount of cash or that amount of capital that you aren't ready to deploy into investments immediately. So for most people, when they're chatting about, let's say, portfolio structures, or whether they have risk on versus risk off, or growth versus fixed income, you'll hear us talking a lot about policies being a fixed income replacement. And why we do that is, first of all, it grows in a similar manner, right? If you've watched a YouTube video out there and you hear someone saying 8% cash value growth or 12% cash value, though that is not true. You're not going to get it to grow that aggressively. What we can do, though, is we can get it to grow like fixed income products. I use here in Canada, like GIC-like growth is sort of what I look at. But when people are talking about their mix, they often forget to include that safety bucket, that money that they weren't planning to do anything with because they have it just in case. For some people, that's cash sitting in a, high yield savings account. For others, they have GICs that they ladder and it's just sort of there just in case. For business owners, that's usually a really high amount. Like, there's usually a large amount of cash. And in their mind, they picture that cash as not part of their investment portfolio because they actually consider it part of the business operations. Like, they look at 50% of their net operating income, or 50% of the capital inside of their corporate structure. They're looking at that and keeping it as cash because they're like, I need access to cash just in case. So when we're looking at this, typically, especially with someone who's new along this journey, we're often thinking about starting small and actually putting yourself in a position where you kind of look back in a year or two and go, I wish I went bigger. Like, that's a much better place to start, so that you can get the wheels turning on the process. You can start understanding how do policies work, how do the structures work, and to get comfortable with the idea of leverage. Because from a rational standpoint, especially for incorporated business owners, we can make the rational case that getting every available retained earnings dollar into a policy and then leveraging out to use for business operations, for putting it into the next investment property, for putting it anywhere you want to go, we can make the case for why that makes sense. But you know what's really hard to do is actually to help make the case to your emotions that that's the right move, right? So I think starting small and really looking at and focusing in on the money that is sitting there and that you're not planning to put into long-term assets right away. Again, there are some people that are a little bit more aggressive on this strategy and they're ready to go. They've done a lot of research and they know exactly what they're signing up for, and that might be different for them. But for a lot of people new to this journey, getting something small started is a great way to start slowly building that corporate wealth reservoir, or if it's on the personal side, a personal wealth reservoir. And then over time, starting to scale that up as you get more and more confident in the strategy and feel like you have a trust in the actual numbers and that everything is making sense based on the plan.
Yeah. Like the way I look at it is if you were looking at it and going, look, I want to reserve 50% of my retained earnings for emergencies, and it's cash, it's sitting there, it's just idle, it's just kind of like you're managing in your bank account, and then you're deploying the rest. And it's, cause sometimes and this is what we did early on, is to say, you know what, like when we trickle that, you know, our retained earnings at, say, at the operating level up to the holding company level, it's like, well, now let's develop a plan for distributing that into different investment buckets. How much goes into that bucket? How much goes in that bucket? Well, how much do we keep just in case? It's like that just in case. What we started to do was just say that just in case is now the emergency fund, but now that goes in our insurance policy bucket, but it's earmarked. It's earmarked to be the emergency fund. Also combined with our opportunity fund, so that when we need an emergency or when we need the opportunity, we go to the policy, holder, or the policy. We're the policy owners, but we go to the carrier and say, "Hey, we're going to take a policy loan on that because we need the money." And they're saying, "Where's the bank account? You center there." And then all of a sudden, now we have our emergency, money when needed if an emergency arrives. So it's like it's still liquid, but I'd rather see it sitting there earning, like you said, GIC level growth when it's just normally just sitting there. And it's usually that was the way the waterfall method was working. It was like the money was getting here, we replenish it here, and then we move it here. But then there's always this pot sitting there just in case. And it's like, well, we put that pot to use. We just said, hey, it's still ready to go. It's just in use. And I remember on my personal side, when we restructured, it was like, I don't know, personally, in terms of my budget, you know me with budgets, it was like, I know every dollar went. And it was like, well, maybe I don't have enough to like start a policy in terms of to create my emergency bucket, my opportunity bucket, my wealth reservoir on my personal side. But when we looked at it, I was like, well, this is how much was going in savings. That's the same thing my retained earnings were doing. It was like, here's this bucket sitting there doing nothing. It's like in my savings account, because I was like, every month we're going to put away some savings, make sure that's my emergency fund. But then it's like, also, I'm putting away a little bit for my tax payment at the end of the year. And also, I'm putting away my RSP money. I'm dumping it into RSPs. Also, I'm putting in the tax-free savings account. Also, I'm putting it over into an investment on unregistered accounts. It's like when you add all that up, that's a good chunk of your salary that you're dedicating towards long-term investments, long-term growth, opportunity funds, and emergency funds. It was like that right there forms the basis for my wealth reservoir. And all of a sudden now I'm going to take that lump sum. That's my policy. I got my range to make sure it's like, hey, what's my top end? What's my bottom end? But if I make more, great. We've got that next choice, which we're going to talk about next. But it created this place that I could feel confident with to also know that that money wasn't just sitting there doing nothing, but it was ready to go, ready to deploy, and making use of it while it was there. It wasn't,
right.
It was two uses to the same dollar. That money went in there, and it was earning the GIC but then when I borrow it back and I put it in my tax-free savings account for long-term retirement, now I'm earning, whatever the investment is over there on the arbitrage between the rate I was borrowing. So, these are the things that we think about, and that's why I want to share them. Like, these are the moves, the secret sauce moves we've been making to make use of the wealth reservoir idea, which is kind of stage 2 of our healthy financial plan. Now, here's the question I want to throw at you, because when we establish a plan like we have and our clients have, and using it like a wealth reservoir, and we realize that we get to that situation where it's like, I now have more of my opportunity fund available. I've got more retained earnings in my corporation, and I want to still have that same philosophy. I don't want that to be sitting there doing nothing. But I've now maxed, like I paid my premium, my max of my premium this year. I want my line of credit to keep going up, but I can't do it yet. So it's kind of like you'd like to go back and adjust that policy and say, can I make it bigger? Because I want to be able to put more money into the wealth reservoir tool to make use of it. But what we're doing is we just open another policy. And Kyle, talk to us about like downfalls, benefits, second policies on top of, or not on top of, but side by side with other policies.
Yeah, like I think like when you're starting the process and you're like, okay, I know I want to get this going, you kind of fall into one of two camps. So what you're referring to is the most common camp, which is this idea of like, I'm going to start the reservoir. I'm going to like for now use it as a fixed income like bucket that I'm going to use if and when I need it. But my plan isn't to necessarily immediately leverage it, as soon as it goes in force. So usually that bucket is a lot smaller than, say, the other end of the spectrum where somebody comes in, they're like, actually, I've got a large sum of money or I have a lot of retained earnings, let's say in the corporation. I want to start getting this bucket going. I want to get as much of this retained earnings that I built up over a number of years into a policy. I want to be able to sustain that policy. And I'm thinking I'm going to start leveraging this in the short to medium term, meaning I might maybe be buying a building in the next year, or I might be, investing into another business or private equity or something else like that. There's kind of these two ends of the spectrum. And the one end of the spectrum where you're kind of using what we call like the leverage later strategy. It's like, I'm going to put money here. I don't really see a need for this money in the next 90 days, even maybe year. It's going to be more for fixed income like anyway. It was going to go and sit and earn interest or GIC interest, or maybe it was just going to sit there and wait for an emergency if and when it happens. What ends up happening there is we actually encourage you to go pretty small on that bucket to start, because we don't want to tie up too much of the money that you're planning to put into investments right away. So if we use the most basic scenario, someone who's dollar cost averaging into ETFs, if your plan isn't to immediately leverage the policy and put it into the market because maybe you're not confident in, using that leverage to go into the market or whatever the reason might be, we don't want to put too much of those dollars into that bucket unless you are a more conservative investor, right? Maybe you're more of a balanced investor and you want 60% in growth and 40% into fixed income. Well, guess what? 40% of those dollars, a great spot for it to go is into that policy. And as you grow, what you might find though is that you go, you know what? I actually want to start utilizing this opportunity bucket or this wealth reservoir in order to buy more growth assets. And that's when you'll start to go, oh, shoot, I kind of wish I coulda, woulda, shoulda had a bigger policy. But let's be honest, it's emotionally easier to start a small policy, right? Without a huge amount of commitment from year to year. So now we're going to start looking and saying, okay, maybe you're at that stage where you want to open up the next bucket. And maybe that bucket has a larger chunk of your available capital. If, let's say, you're an 80-20 investor, so that could be 80% into real estate, 80% into the markets, 80% into private equity, maybe it's 80% spread around all of those asset classes, you might now start to recognize that, you know what? I might still build up a bigger than 20% of my available capital bucket here so that I can leverage a portion thereof into some of these growth assets. As income comes back, I can refill that bucket and I can start looking at the next opportunity. So ultimately, at the end of the day, when you're getting started, those two camps are very different camps. It takes a lot more of emotional, mental strength to start a big wealth reservoir,
Right.
or maybe a large amount of retained earnings that have been sitting, which is not uncommon for a lot of business owners, right? What started as an opportunity fund or an emergency fund in the building or in the business kept growing. And then you almost sort of start to go, I don't know if I want to take and deploy all of it, half of it, some of it into a risky asset class because you're like, I put my sweat and tears into this. They want to try to get a nice large policy going. So there's kind of two kind of camps here that you might fall into. And I'd argue that for most, starting with something small is likely, if you're being successful with it and you're successful in your planning, you're going to want to add on another policy in future years. And actually, I'll be honest and say the most successful people end up having more than one because that's just the way it sort of rolls. And, John, you and I are great examples of that.
Oh, yeah.
We started small, and over the years, we started to recognize how valuable this tool was for us in our journey. And now we're kind of on the other end of the extreme ourselves, where we try to get all of our retained earnings to touch a policy
multiple
before those dollars go back into the business or other investments.
Would you think about someone who, obviously, let's say I'm a business owner, I've got retained earnings. Is there a case where you're like, this is not a good choice for you? Like the wealth reservoir tool, corporately owned, whole life policy, structured specifically to act as a wealth reservoir. Is there a case or cases like what if I'm listening right now, how do I know that this is not the right move for me in my business?
That's a great question. I would say that, if you don't have retained earnings from year to year, so we often use the word successful business owners because a successful business is going to have profit. And that profit, after you've paid all those expenses and taxes and even your own salary, right? The salary you need to live on for your lifestyle personally, that's going to leave retained earnings. So if you're successful, it's going to make sense. Now, where it's not going to make sense is if, let's say, the business has some retained earnings, maybe it's a small amount, I'll use 1,000 as example, and you aren't sure what next year is going to be like or a couple years from now, or maybe you're winding the business down completely and you're going, you know what? I have 100,000 in retained earnings right now. I'm going to do this for 2 more years. Maybe I get it up to like 150,000 in retained earnings. Well, I mean, you could probably use what we call the slow drain method to just kind of like slowly drain that out over a number of years. That means you're going to have to keep the corporation, open longer, and you'll just slowly take little by little out, and you're going to pay tax on that, right? That's the trade-off, but you're going to pay a less amount of tax. But for most people that have retained earnings, and for people that have, I'll call it like a reasonable runway. Usually if you have like at least a 2 to 5 year runway, or even if you have a short runway on your business, you don't plan to keep doing this for much longer, but you have a large amount of retained earnings, quote unquote, trapped in there, right? On paper, it's saying I got $1 million in retained earnings, or I've got, whatever that number might be. It can definitely make a ton of sense for us to build a very, very well-structured policy, try to get it funded as early as possible for the least amount of time, so that now you have this tool that you can use for leveraging, for potentially for some, good cash flow without triggering taxes and all kinds of other strategies that'll help you to ensure that that tax on retained earnings is going to be minimized over the long term.
Right. So we encourage you, when we think about our 4 stages, our 4 phases, our 4 structures of a healthy financial system for your corporation and also for your own person. Stage 1 we often talk about is our vision process, making sure that we know our numbers, making sure we know what we're shooting for, what are our goals, what are our life goals, what is the target number for retirement, or if we are planning a retirement, we have to describe that, we have to have a clear vision, otherwise no roads lead it everywhere and everywhere leads nowhere. And so that's really important for stage 1. Stage 2 is about establishing the reservoir. That's what we've been talking about here today, the tool of choice that we use in our own businesses and we recommend for corporately owned business owners when they meet certain criteria, like Kyle has just described. Is that whole life policy well structured, very carefully structured for that purpose? Stage 3 is about optimizing your existing structures and making use of that wealth reservoir to optimize and use the secret sauce moves to make sure that we're setting ourselves up for the vision that we established in stage 1, but also minimizing the taxes along the way. And then finally setting us up for stage 4, which is making sure that we count for our legacy and also our estate. And the tool there helps that as well. If you are looking to figure out where, what part of the journey, but also what stage you have strength in, you can head on over to CanadianWealthSecrets.com/pathways. There is an assessment there to fill out, and we will give you a report. It shows up in your mailbox that outlines, the 4 stages and your strength on those 4 stages, and gives you some next steps. You can also book a meeting with us. We can look at your situation, talk about your wealth reservoir strategies, and then help you establish one. Head on over to CanadianWealthSecrets.com/discovery and book that meeting today.
All right, Canadian Wealth Secret Seekers, we will see you in the next episode. And just as a reminder, this is not investment advice. It's for entertainment and educational purposes only, and you should not construe any such information or other material as legal, tax, accounting, investment, financial, or other advice. And I, Kyle Pierce, am a life license and accident and sickness insurance agent and the president of Canadian Wealth Secrets Incorporated.